Now we flip to the other side, to liabilities. The tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. Now I just want to focus on one bit of that, which is important, and it will be a really useful hack if you forget what leads to a DTA and what leads to a DTL, which is it's a carrying amount less another amount. Now I'm assuming you cannot get negative deductibles. You know, it's a big world out there, maybe you could, but I'm pretty sure that I've never seen one, which means the carrying amount is the starting point, and that tax base can never be greater than the carrying amount. It can be less than, but it can never be greater than. And that's important. It makes life a lot easier when you're figuring out if it's a DTA or DTL. So, I have a question for you guys. If you see the following, I don't know. Might be a friend, might be, you know, looking to do some, you know, got some money to invest somewhere, they're looking at a company, they see this, might be mum or your dad, and they go, you see this account provision for long service leave, $50,000 in the balance sheet. And you go, what does that mean? We've done employee benefits. What does that actually mean? What does that tell us is going to happen? Yeah, it tells you, the company expects to pay $50,000, you know, has an expected $50,000 outflow that's going to happen. We know how that's been calculated. We know that it's a present value because that's a future outflow. We know there's been kind of risks taken into account, so whether or not that person will stay or whether that person won't, or, you know, whether people will stay and actually get their long service leave or will leave before the long service leave. It's a provision, so it's not going to be perfect. It's a provision as a liability of uncertain timing and amount. So it's not perfect, and we know that. But that's saying, as best as they can tell, there is going to be a $50,000 outflow. That's what a liability is. It's an outflow, or expected outflow. Now that's what's going to happen. You are basically saying, at some point in the future, this company is going to pay out, as far as you can tell, $50,000. From a tax point of view, when they pay that long service leave, what happens? Yeah, your taxable income gets lower because long service leave gets taxed based on when it gets paid. So what that's picking up is that there is going to be some sort of future event which will happen, and when that event happens, cash will obviously reduce and you get a tax deduction for it. So you will get a tax deduction of $50,000. You get a tax deduction of $50,000. Let's say the tax rate is 30% and we expect it to stay at 30%. If the tax rate's at 30%, how much less tax do we expect to pay? So expect okay, so seeing there's a provision there, so we haven't done the tax effects of provisions before, but seeing a provision sitting there of $50,000 for long service leave tells us, in a real sense, that we expect to pay $50,000. So we expect to see this outflow. It also gives us a clue as to what the tax effect of that's going to be, because we know how the tax works for it, and we get a deduction at that point in time, which means we expect to pay less tax to the tune of $15,000. Now, that number, that $15,000, is either a DTA or a DTL. And I'm pretty sure everyone in this room, it's a 50-50 shot. I'm pretty sure everyone in this room knows whether it's a DTA or DTL. And I'll preface that, would you argue from a company point of view, is paying less tax a good thing? Yes. Philosophically, you could argue whether companies paying less tax is a good thing, but I suppose from the company's point of view, paying less tax is a good thing. So with that answer in mind, Is that likely to be a DTA or a DTL? DTA. So we have a 15,000. We haven't even gone through the actual definitions of what DTAs and DTLs are, and we've already got a sense of what it's meant to be. So that would be picked up as a $15,000 DTA. Now, if you may actually also start to pick up what some of the issues around accounting for tax have embedded in them. For that to happen, for us to pay less tax in the future, it might be too early in the night for it, but can anyone maybe ever think about what has to happen for us to be able to pay less tax in the future? You have to. You've already paid taxes now. You've got to be paying taxes. You've got to be paying taxes now, but it's along those lines. There's something about paying tax. All right. We'll leave that thought for the moment, but it is something to do with, to be able to pay less tax, something has to be going on for that to happen. Also think about, we're making an assumption there about what future tax rates are going to be as well. So these sort of embedded things which are going on. So I'll leave that to percolate. So the tax base of a liability, so we'll have a look at the slide, which is not the slide I wanted. We'll have a look at the slide, which is what we've just done. And we actually went further than what this slide picks up. So the long service leave liability, 50,000. Long service leave expenses are only a deduction when paid. The tax base is 0. Because you start with the carrying amount and you take away from that carrying amount the future deductible amounts. You get a deduction of 50,000, so you start with 50, you take away 50, that gives you a tax base of 0. Interest revenue received in advance, we haven't actually looked at that. In the case of revenue received in advance, the tax base of the resulting liability is its carrying amount, less any amount of the revenue that will not be taxable in future periods. So if we have interest revenue received in advance and that revenue is taxed on a cash basis, and generally interest does get done on a tax basis, the tax base is 0 because you start with the 10,000 and you take away the 10,000 when you're not going to get taxed in the future, so you end up with 0 again. I'll throw open a different question to you guys. Another example. Tax base of a liability is its carrying amount less any amount that will be deductible. If I have borrowed Christina. If I have borrowed $300,000 from Christina, so I have a loan payable. If I pay that $300,000 back to her, do I get a tax deduction? We're not worried about the interest components of it. I'm just worried about the actual principal amount. If I just give her the $300,000 back, do I get a tax deduction, do you reckon? We haven't looked at the tax laws. But do you think logically I would get a tax deduction just for giving her her money back? No. If you could, people would be borrowing money and just giving it back, almost immediately all over the place because you could just get your tax deductions enormous. So a tax base of a liability like a loan, the actual loan component, we're not talking about any interest payable, things like that, but the actual interest expense, well, that's not a liability. But about the actual loan itself, the carrying amount is a 300, less any amount that will be deductible. Well, in this case, there's nothing that's deductible, so you actually will generally see the tax base of a loan is equal to the carrying amount, and so there's no temporary difference there. Tax base versus carrying amount. You don't need to remember the definitions because you will have them with you. But as I was saying, and just having a look at it for 45 minutes or so now, you're going to have to spend some time with it. It's just part and parcel of it. But you need to get a sense of how this is working. So the idea of a liability, it's about that deduction, future deduction. So if you have a provision for long service leave, when does the deduction happen? What's going on with that? With a provision for warranty expense, for warranties, what happens with that? That helps. What we then move into, and we've started having a look at this, is temporary differences. And the thing with temporary differences are, In a way, yes, we have this demarcation between taxable temporary differences and deductible temporary differences, and one gives rise to a DTL and one gives rise to a DTA. In a sense, that kind of makes it a little bit more problematic than it needs to be. And I'll show you why that's the case. So we start to see this sort of stuff. A DTA occurs when the tax base of an asset is greater than its carrying amount for an asset, where a DTL for an asset occurs when the tax base of an asset is less than the carrying amount of an asset. 90% of the time when you see a temporary difference for an asset, it's going to give rise to a DTL. Like, just the majority of the time. It's not foolproof, but you know, if you're lost in an exam, you say, I figured out the difference, I don't know what it is, it's odds on it's going to be a DTL.